The global pricing system just fractured in public. For years, silver had one price, one reference, one supposed truth. Now it doesn't. On one side of the world, buyers are bidding like silver is running out. On the other, markets are still pretending everything is normal. That contradiction is the story, because when the same asset trades at radically different prices, it's not volatility, it's loss of control. And when control slips, the damage doesn't stay inside trading desks, it spreads outward. This matters to you because price is how the system tells you what's scarce and what's safe. When price lies, every decision built on it becomes unstable. Savings, timing, trust. Right now there's a widening gap between silver on paper and silver you can actually hold. In a functioning system, that gap should close instantly. It hasn't. It's growing. And here's the part nobody wants to say out loud. This isn't a temporary glitch. It's a structural failure. So ask yourself this. If the official price can't buy the real thing anymore, what exactly is being priced? Because once physical reality stops obeying paper rules, the reset doesn't ask permission. What you're seeing didn't appear overnight. It's the result of pressure building quietly, then leaking through the weakest point. Here's the core event. Stripped down, physical silver is trading at dramatically different prices depending on where you try to buy it. Not futures, not promises, real metal, delivered, paid for, and the gap between regions isn't shrinking, it's holding. That alone tells us this isn't random, it's part of a larger pattern. When markets are healthy, geography doesn't matter much. Capital moves, metal moves, prices converge. But when systems strain, they fragment, rules diverge, access becomes uneven, and suddenly location decides value. Notice how this is being framed publicly. You'll hear about volatility, speculation, temporary dislocations. What you won't hear is the more dangerous question. What if the pricing centers everyone relies on are no longer setting the price at all? Because price discovery only works if sellers can deliver and buyers can trust settlement. Once either side doubts that, behavior changes quietly at first, then all at once. So this isn't just a silver story. It's a test case, a signal, a preview of what happens when paper markets collide with physical limits. And once that collision starts, it doesn't stay contained. There's a claim sitting at the center of this, and it's uncomfortable for anyone who believes the system is still in control. The claim is this: Western pricing no longer reflects physical reality. Here's what we can say plainly. In parts of Asia, buyers are paying triple-digit prices for silver and still taking delivery. At the same time, Western futures markets are posting prices far lower, as if supply is abundant and accessible. That gap isn't flashing for a second and disappearing. It's persistent. In a functioning system, that should be impossible. Normally, traders would step in immediately, buy where it's cheap, sell where it's expensive. The spread collapses. That's how price discipline is enforced. But that mechanism has stalled, and that tells us where the real constraint is. It's not information. Everyone can see the prices. It's not demand. Demand is obvious. The constraint is physical access. Paper contracts can be created endlessly. Physical metal cannot. When more participants insist on delivery instead of exposure, paper liquidity stops mattering. Here's the detail that changes how this looks. Buyers paying higher prices aren't chasing momentum. They're securing metal. That behavior only appears when confidence in paper settlement weakens. Now notice what isn't happening. There's no forceful reassurance that supply is ample. No aggressive arbitrage pushing prices back together. Just silence and business as usual language. And silence at moments like this is information. Because if the system could close the gap, it already would have. So the question sharpens. If prices can diverge this far without correction, how much control is actually left? And once that question enters the market, escalation becomes inevitable. This is where pressure turns into escalation. Because when a pricing system can't force convergence, it doesn't surrender. It defends itself. Historically, markets under this kind of strain don't announce failure. They introduce adjustments, technical changes, risk controls, measures that look neutral but change behavior fast. You've seen versions of this before. Costs to participate rise, requirements tighten, access narrows. The goal isn't to fix the imbalance, it's to slow the people testing it. And here's what should feel abnormal. Tools that were designed for rare emergencies start appearing more often. What used to be temporary becomes routine. What used to be exceptional becomes policy. This is how abnormal conditions get normalized. Language shifts along with it. Instead of scarcity, the conversation moves to orderly markets. Instead of delivery, the focus shifts to cash settlement. Instead of asking why prices don't align, attention is redirected toward volatility management. That's not coincidence. It's insulation. But insulation doesn't remove heat. It traps it. And while these measures may cool surface activity, they don't increase supply. They don't restore trust. They simply buy time. The problem is that time under pressure doesn't stabilize systems. It weakens them. So the real question becomes this. If defenses keep stacking and reality keeps pushing back, what happens when the next layer gives way? Now the evidence gets harder to explain away, because while the system talks about stability, behavior tells a different story. Institutions that normally sell freely are hesitating. Products quietly disappear. Availability thins out, even as prices on screens suggest nothing is wrong. Here's the contradiction that changes how you see this. If supply were truly abundant, sellers would rush to meet demand at higher prices. Instead, many are slowing down, repricing, or stepping back entirely. That's not optimism, that's replacement risk. Think about what that implies. When holders of physical silver worry they won't be able to buy it back later, price stops being an incentive to sell. It becomes a reason to wait. This is the moment markets hate, because rising prices are supposed to attract supply. When rising prices scare supply away, the feedback loop breaks. Notice what's missing again. There's no surge of new metal flooding in to restore balance, no wave of confidence selling, just delays, pauses, and quiet recalculations behind the scenes. That tells you something fundamental has flipped. Price is no longer the signal. Availability is, and once availability becomes the signal, every participant starts acting defensively. Buyers rush earlier, sellers hold longer, middlemen protect themselves. This is how stress turns systemic, not through headlines, but through thousands of rational decisions that all point in the same direction. And when that happens, the next phase doesn't creep in slowly. It arrives all at once. At this stage, the pressure no longer comes from a single source. It stacks, and it stacks fast. Physical demand keeps pulling metal out of circulation, not to trade, but to hold. Once silver is locked away, it doesn't cycle back easily. That alone tightens the system. At the same time, participation becomes harder. Costs rise, requirements increase, access narrows. These aren't signals of confidence. They're signs of a system trying to slow the people, putting the most stress on it. Then add uncertainty. When nobody trusts that today's price will still secure supply tomorrow, hesitation disappears. Decisions get rushed. Timing overtakes analysis. Put those together and control starts slipping in visible ways. Trades still clear, screens still update, but the margin for error is gone. One delay, one miscalculation, one unexpected surge in demand, and the system has no cushion left. This is the point where continuity becomes dangerous, because pressure plus time doesn't equal stability. It equals fatigue. So ask the question that's now unavoidable. What happens if demand doesn't cool? What happens if holders don't sell? What happens if pricing tools stop shaping behavior at all? Because if this continues, the next shift isn't about volatility. It's about who actually controls the metal. This is where it stops feeling distant and starts touching ordinary life. Because when control weakens at the top, the effects don't stay there. They travel downward, quietly, into availability, into timing, into what people can realistically access when they decide they need something real. For most people, it doesn't arrive as a headline, it arrives as friction. Products that used to be easy to buy suddenly aren't. Limits appear, waiting periods stretch, prices feel disconnected from what you saw just weeks ago, and the explanations are always soft. Logistics, demand cycles, temporary adjustments, but stack enough temporary explanations together and a pattern forms. Put yourself in that position. You're not trying to speculate. You're trying to protect value, plan ahead, or lock something in before conditions change again. And suddenly the question isn't, is this expensive? It's, will this still be available if I wait? That shift matters because it's not driven by ideology. It's driven by experience. When people feel access slipping, behavior changes fast. They stop trusting timing. They stop waiting for confirmation. They act earlier than they plan to. If this feels familiar, say so in the comments, because you've seen this before, not in metals, in housing, in energy, in food. First availability tightens, then prices jump, then clarity arrives too late, and once that cycle starts, it rarely unwinds gently, which brings us to the deeper mechanism that allows all of this to happen in the first place. What makes this possible isn't chaos, it's design. Modern financial systems are built to favor flow over fulfillment, volume over delivery, optics over inventory. As long as trades clear and prices update, the system declares success. Physical settlement is treated as optional, even inconvenient. That works only when trust is intact. Because the real leverage isn't metal, it's belief. The belief that paper claims can always become something real later. As long as people accept that delay, the system stays calm. But when confidence thins, incentives flip, holding becomes rational, delivering becomes risky, institutions respond the same way individuals do under uncertainty. They preserve options. Here's the uncomfortable insight: no conspiracy is required, no single actor has to pull a lever. Each decision makes sense on its own. Raise requirements to manage risk, limit exposure to reduce volatility, settle obligations in cash to avoid logistical strain. Individually, these look like safeguards. Systemically, they drain trust. So this isn't a story about bad actors. It's a story about a structure optimized for stability on the surface, not resilience underneath. And systems like that don't fail when challenged aggressively. They fail when too many people rely on them at the same time. Which leads to the next question. If this structure can't absorb sustained pressure, where does that pressure move next? From here, the trajectory splits, but neither direction brings relief. One path looks controlled. Prices keep rising, but within boundaries. Access tightens quietly. Participation concentrates in fewer hands. The system adapts just enough to survive, but not enough to restore confidence. In this version, you're told everything is functioning, even as fewer people can actually obtain the underlying metal. The other path is faster and rougher. Pressure builds beyond what adjustments can contain. A single trigger forces reality to surface. Delivery delays become unavoidable. Cash settlements replace physical ones. Prices reappear higher somewhere else before they update on official screens. Not a collapse, a repricing. Here's the key point. Both paths lead to the same outcome. Control shifts away from paper mechanisms and toward whoever already holds the metal. Notice the uncertainty in this moment. There's no announcement, no official turning point. Behavior changes first. Recognition comes later. That's why what happens next matters more than any headline. Decisions are already being made quietly. Inventory is being repositioned. Supply is being redirected before most people notice. The market hasn't chosen which path it will take yet, but momentum is no longer neutral. And once momentum tilts, it doesn't slow down to explain itself. There's one idea that pulls this entire story into focus. This isn't about silver becoming more valuable, it's about trust becoming more fragile. For decades, the system worked because people believed that paper claims could always turn into something real later. That belief kept everything smooth. Once it weakens, price gaps open, behavior shifts, control erodes without drama. That's why this moment feels strange instead of explosive. Markets still function, screens still update, but underneath, friction is growing. Delays, divergence, quiet hesitation where confidence used to be automatic. Those are the signals that matter, because real transitions don't announce themselves with sirens. They reveal themselves through resistance, through the growing distance between what's promised and what's delivered. This story doesn't end here. What's happening to silver is a preview of a larger recalibration already moving through the system. If you want to understand where this goes before it becomes obvious to everyone else, follow and subscribe. We'll keep pulling this apart layer by layer before the next shift becomes impossible to ignore.